Hello, this is Brian Shannon from Alphatron's Blogspot. Today is Wednesday, December 5th, 2007, and the market's closed. The S&P 500 did gain $2.42 or $1.65, and I've been talking about all the mixed messages in this market lately from the various time frames, and we continue to see that. However, there is maybe a little bit of clarity unfolding here. I was talking about the potential for a turn. I definitely didn't have any confidence that there would be one, but I was suggesting that maybe this low volume here suggested that the sellers were kind of drying up a little bit, and that could catch a lot of people off guard and send the market higher. And it seems as though that's what happened today with a little bit of fundamental catalyst. We still have very mixed signals. We've got this declining 50-day moving average. That's not a good sign. The market is back above the 200-day moving average. And it looks like this pattern that I've been talking about for the last 4 days or so is actually materializing. Now, it's not going to be completed until we can see this market back above 150 or so on the inverted head and shoulders pattern here. But you can clearly see that it's really taking form here on this 30-minute time frame. And realistically, you know, the neckline maybe breaks about 149, 149 and a half. But I think just for a little bit further confidence, I'd also like to see it retake that 50-day moving average. If you remember back to August, this inverted head and shoulders pattern I had pointed out back here, it kind of ran up to that level, backed off like they often do, and then the next move is when it took it significantly higher. So it's still very uncertain. These head and shoulders patterns don't always work. They're not some kind of magic pattern that always leads to gains. In fact, a lot of times patterns fail, so you have to be alert for anything, and that's the most important thing I think that I've been saying lately, is that this market's going to catch you off guard. It's going to come back and forth, but we are seeing, like I said, some clarity in here. If you take a look at the what we looked at yesterday was this Fibonacci that, based on the most recent leg higher from the pre-Thanksgiving Day beginning, is when we saw that rally, actually the Friday after Thanksgiving, to just the recent lows. It had retraced exactly 38.2% retracement. And a lot of times the markets find support in there. It didn't mean it would, because it certainly closed weaker yesterday as well. The market really wasn't looking good here, and I had said that it really needed to get back above and hold for about a half hour or so, back above that 147.50 level. And obviously the gap higher today caught a lot of participants off guard. It was really choppy there earlier in the morning. It looks like I wasn't there to trade it, but then we saw that the buyers firmly took control in here. And then a little scare over here later in the day, but my chart didn't update all the way. Couple little scares, but buyers did come back in at the end of the day and firmly took control of this market. So you can see that today a little bit of resistance was formed near the 149 level. So getting above that 49, 49 and a half, then we can start looking at potentially a bigger year-end rally that could, you know, if you take a look at the height of this pattern here, we'll just call it 140 and a half. Let's just call it 141 to be conservative, and take it up to the height of 149. So that'd be 8 points. Add that to the 149 level. That'd give us a target right up near these highs. So anything can go basically until we start to see this market really on the weekly time frame give us a better idea of what the overall direction is really ultimately going to be here. It's still, it's easy to look at this and get excited about what looks like a inverted head and shoulders pattern, but just continue to maintain your discipline. This 5-day moving average is going to be important, just below 148, as it is also these lows from today. So continue to see these mixed messages, and I still think that you've got to be an aggressive day trader in here. And you're going to miss some of these opening gaps, but what you're going to do is preserve your capital by not being on the wrong side, and also I think preserve your sanity, so when the market does open, you can look at it much more objectively and see what's really happening there. The semiconductors, I'd said that if we were to see, if it was, I've been saying that they're the worst looking group, which I continue to believe is true. But we are seeing what might look now like a higher low in here. Now, these rallies typically fail if something can unfold in here. and maybe it gets up to the 50-day moving average. Maybe the semis get back up to that 450 level. I'm not making that call. It's just a suggestion of what's potentially possible in here. But you can see this is where the resistance is right now at about 425 or so. And we do have this higher low. So getting back above 425. Yesterday I said that the market needed to get above 418 before we had a chance of thinking that the semiconductors could hold on to any strength for more than just a very short period of time. So it's back above 418. Let's look at 418 now as a potential support level, breaking back below that, and then this low here will invalidate this whole potential move higher, but getting above 425 will further strengthen the case for a continued short squeeze rally. And that's all it is at this point. Is, you know, you've got to look at it as a potential short squeeze rally, not as anything to get excited about on the long side. The IWM has been the biggest reason for concern. It still is the biggest reason for concern. However, we have seen the market find support 73 numerous times in here, and bullishly it's looking like it might have made a higher low. Now this low here at about 74.5 will be an important level going forward. Breaking below that then does put that 73 level back in jeopardy, and again breaking below 73 causes bigger problems on the longer term time frames. But it doesn't look as though that's something we have to worry about right now. We do still see a declining 50 and 200-day moving average, which means that any rally that unfolds here is still high risk until those can flat. So it's going to take a lot of time for this not to be a trader's market. So that's something you're going to hear me consistently say, I think, for the next couple months in here. Whether this thing breaks out to the upside or the downside, I still think that we've got a lot of healing to do in this market. And you know, usually it just takes a lot of time. So bullishly, the market is back above that 75.80 level that had been holding its support in here, resistance back there, and support back here, resistance a couple times, and then support back in here. So it's back above that. It dipped below short term, you know, just during the course of the day today. I think sucked in some more bearish players, so that's good because it means that that's more potential upside fuel for this market if it can get going. Right now, I think that the next level that it needs to get above for a little bit more confidence in this rally is right up here at about 76.80, let's call it. So up near 76.80, 75.80, and actually this low right here, 75, which is called 75.50. 75.50 is an important level of support right now. That's yesterday's highs. So resistance broken tends to act as support. And we're seeing that unfold all over the place here. And that's, again, the fractal nature of the market, is that it repeats these patterns and support broken becoming resistance repeat on multiple time frames. That's why you only have to learn it on one time frame, and it's applicable to any approach that matches your personality, basically, and your risk tolerance as far as what time frame you personally decide to trade on. So we are seeing the market firm up a little bit in here. It's still a mess here on the daily time frame, but it's firming up, and we could continue to see some further upside due to short squeezes and some bargain hunting and people who are there to believe in a year-end rally. The NASDAQ 100 came back up to that 50-day moving average and found resistance there again today. So that's the second time in the last 4 sessions that the market's found a little bit of selling near that 50-day moving average. And again, that level is further strengthened, just to remind you, because it was resistance that had become support on numerous occasions, and it was also the retracement of this move from this low to there. So almost 61.8% of the move from let me just draw that in with a regular line, from this sell-off here, 61.8% retracement of that, just about. So on the intraday time frame, you can see that it's bullish that the market made it back up above this 51 level where we had some support breakdown yesterday and then act as resistance. So what that does is that traps it basically, when the market breaks down like that and then reverses back up to it, traps all those short sellers in who scramble to buy the stock back. and it also gets people who had yesterday been looking at this market from they were long and then got stopped out, let's say underneath that 51 level. They're looking at it, looking to buy their stock back today. And today, who do they buy it from? Well, the people who bought in here recognize there's all that demand in there. They raise their prices, their prices basically by by not offering much supply out on the offers. They make people come chase it at higher prices and make life difficult for the short sellers who got trapped in there. So right now, 51 is going to continue to be an important level for support for this market. And if it can break these highs from earlier in the week, or was this late last week, I guess, then maybe we have a better chance of this market just capturing a bunch of short sellers in here, and we could run up to even new highs for the year. So a lot of possibility as far as what is potentially going to happen in this market, and you have to just remain objective, remain open-minded, and you can't stick with a bearish opinion for too long because it seems as though there are still buyers out there.